Welcome to your homework support for this chapter. I have been assigned the problem 2A, which I was a little perplexed when I got to it because it doesn't appear to be one of the homework assignments that are required on the Wiley Plus. And so I was scratching my head whether I should do this or whether I should do one of the others so that it could be applicable to your homework, and I decided to go ahead and do what I was assigned. So it's in your book, and the numbers are the same as yours, but it is not one that you'll have to hand in. I did find that there were several concepts that were not necessarily applied in the homework, and so this will be a great opportunity for you to credit critique my conclusions that I came to as far as how to do certain things that weren't required in the homework. So here we go. Eller Corporation sells rock climbing products and also operates an indoor climbing facility for climbing enthusiasts. During the last part of 2017, Eller had the following transactions related to notes payable. And so these are listed right here. Our first assignment is to prepare the journal entries for the transactions noted above. And so as we read them, we will enter them into the general journal. September 1st, they issued a $12,000 note to Pippin to purchase inventory. The 3-month note payable bears interest of 6% and is due December 1st. Eller uses a perpetual inventory system. Now, I must admit that little tidbit of information had me scratching my head because I wasn't sure how it pertained to notes payable. I'm hoping it's insignificant information for the task at hand. If it pertains, please take this opportunity to correct me and give me the more information. Okay, so let's enter that as September 1st, and we will debit the cash account because they received the money for $12,000, and we will credit notes payable for $12,000. All right. The next one, September 30th, they recorded the accrued interest for the Pippin note. And the way to determine interest is this interest formula. Principal times rate times time equals our interest. And so we will take the principal of $12,000. Let's see if I can, it's not scrolling, there it is. $12,000 times the 6% interest, and it's only been 1 month since we received the note, and so we're only calculating the accrued interest for that first month. And so that's $12,000 times 6% times 1 month out of 12. So multiply that 1 divided by 12, and that gets us our 60. So let's enter that journal entry, September 30th. We will debit the interest expense, excuse me, for $60. And then we will credit the interest payable for $60. And that enters that information into those accounts so that we can keep a tracking of where the money needs to go and then what we need to have go out. The next transaction was on October 1st. They issued a $16,500 8% 4-month note, excuse me, there's a typo, to Prime Bank to finance the purchase of a new climbing wall for advanced climbers. The note is due February 1st. If you'll note, take note that this was only 4 months, so we are still within our current liabilities. That entry was on October 1st, and we will debit, Looks like I didn't put that in the right. Okay. We will debit our cash account for $16,500. And then we will credit our notes payable again for $16,500. Our next entry was October 31st, and we're recording the accrued interest for the Pippin note and the Prime Bank note. And so that was not asked to be done in the homework assignments. And so this is, I'm hoping I did this accurately. So let's record that October 31st. Interest expense. And when we calculate this, we take the note for $16,500 times the 8% interest times the first month out of the 12. So $16,500 times 8% times 1 divided by 12 gives us $110 interest on that one. And now that we are doing both this note and this note together, we need to calculate the interest for both. And so we'll take the $60 from the Pippin note and $110 from the Prime Bank note, and that gives us $170. And sorry, we need to enter our interest payable account. All right, so our next transaction, come on, scroll, thank you, is on November 1st, issued a $26,000 note, and apparently I was typing fast, and paid $8,000 cash to purchase a vehicle to transport clients to nearby climbing sites as part of a new series of climbing classes. Okay. I don't remember returning there, so that might be interesting. I think we're probably missing some information there. So I will just tell you from what I have here. So on November 1st, oh, pardon me, trying to be consistent. November 1st, we'll enter cash because we received another loan, $26,000. And our notes payable for $26,000. All right, November 30th, we recorded accrued interest for the Pippin note, the Prime Bank note, and this new vehicle note. Okay, so November 30th, we are doing the interest expense and the interest payable. And the way we calculate it is, and here's the information we must be messing up there, and I apologize. The $26,000 note at 6% interest, and it's the first month again. So the first month out of 12. And that gives us $130 for that vehicle note. And when we're adding the Pippin loan, the note, the Prime Bank note, and this vehicle note, that comes to $300 interest for this month. All right, so December 1st, we paid the principal and the interest on the Pippin note. So this only pertains to this transaction. Sorry, if my cursor would work, this transaction here. So December 1st, hope you guys are okay with editing because I'm great at it. December 1st, we are paying off the notes payable, so we will debit that account. We are also paying the interest payable for this particular note, and then we will be paying out cash, so we'll credit the cash account. All right, so the way we calculate this is we take the notes payable, which is $12,000, and we're going to also debit the interest payable, so we can take that off the books, and that total for all of those 3 months is $180. And if you'll note, that's what we paid. We paid $60 here. Let's do it over here. $60 here, and we paid $60 here, and we paid $60 here. So the total has been, or we've calculated 3 months worth, and that's 180. So that checks. And then the total cash that we've paid is $12,180. All right, and the last entry is it recorded accrued interest for the prime bank note, and oh my goodness, I did type fast, I apologize, and the vehicle note. So on December 31st, we're recording the interest expense and the interest payable. And we are only doing the prime bank note, which is 110, and the vehicle note, which is 130. And when we add those two together, we get 240. So let's enter that. Okay. The next part of the assignment is to post those above entries to the notes payable, the interest payable, and the interest expense accounts using the T accounts. So look up here. We have up here, let's get up, thank you, notes payable for $1,200. So let's add that. Our next notes payable is on October 1st for 16,500. The next notes payable is there for 26,000. So November 1st for 26,000. And then on December 1st, we have the credit, the debit of the 12,000. All right, so for our interest payable, our first one is $60 on September 30th. So that is also in our credit, September 30th for $60. The next one is October 31st for $170. Excuse me. And then the next one is there, oh, there it is, on November 30th for $300. And the last one here is on December 31st. So let's do December for $240. All right. Oh, and then we also have the December 1st payment of, so that was debited for $180. All right, so for our interest expense, these are in our debits. So on September 30th, we have a $60.